Next up, how do you decide what percentage of the company is right to sell to investors? Well, the reality is that there's a market for early stage companies, just like there's a market for bananas. And just as the price of bananas goes up and down, the price of early stage companies goes up and down. So I can't give you an exact answer for right now because I don't know. The market might be up or down from where it is today. The other reality is that if you're going out and raising money from angels, then they expect you to set the valuation. They expect you to know what the market price is and to ask for something reasonable. So it really behooves you to go find a friendly angel and get some advice from them. Go to an angel group and get some advice from them before you put together the terms that you think are reasonable. If you're dealing with venture capitalists, it's much easier. You go pitch the companies and they pitch you back a price. They send you a term sheet with a price and terms, all those preferences listed on it. And then you can negotiate from there. All right? Not a lot of negotiation goes on in angel groups, which is a little bit frustrating because you might put out a price, just to be clear, that's a wee bit too high, and all you're going to know is that you got a lot of no's. You're not going to know why, you're not going to know whether or not it was the price, whether or not it was something else. Right, so how do you determine the valuation of your company? Well, in terms of venture capital, which is kind of how the angels do it as well, it's a rather simple formula. Right? You can look at the discounted cash flow, you can look at the internal rate of return, you can look at comparables, but really what it comes down to is one simple formula. How much money do you need to get going divided by 0.67? And that might sound really terse and crazy, but here's why it's true. You have a need. You need capital in order to get going, and whoever's putting in the money, your investors, need a 10x return in order for them to make it worth their time to invest in your company. So imagine that $200,000 investment comes your way as equity, and you decided to sell 1% of your company for $200,000, right? It's a crazy valuation. I'll tell you why. Because that investor expects a $2 million return on that $200,000. Okay, how would they get a $2 million return if they only own 1% of the company? Well, the only way that happens is your company sells for $200 million. So just be clear, that means you took $200,000 as startup capital, and within 7 years, 8 years, 10 years, you turn that into $200 million of value. I don't think any company's actually done that. That's pretty near impossible. Whereas if you sold for $200,000 half your company, which you wouldn't do, but nonetheless, if we just said it was half your company, then in order for them to make $2 million, you only have to sell your company for $4 million. Right? Half of $4 million is $2 million. Okay? So the truth lies somewhere in between that. And the truth in normal markets is that the investors want 40% ownership of your company. Right? In the venture capital world, this is rather simple. They have a rule of thumb that says they need 15 to 20% ownership in each of their investments, because if that happens, it's reasonable to get a 10x return, and venture capitalists generally invest in pairs. So that gets you to 40%. In a good market, you could sell 35%. In a great market, you could sell 30%. But in a normal market, it's 40%. And therefore, 4/6 of that is 0.67. So if you look at this as a chart, they wind up owning 40% of your company, and you wind up owning 60%. So let's take this out of the hypothetical and look at an actual valuation. So for example, suppose you need $1 million, a nice round number. Well, then take 1 million divided by 0.67, you get 1.5 million. That's your, what we call pre-money valuation. The value of your share of the company is $1.5 million. You add in the $1 million to find the post-money valuation, and you get $2.5 million. That's the entire pie. Well, $2.5 million times 40% is the $1 million they put in, and 1 million divided by 0.67, 2/3, is the $1.5 million that you started with. It really is as simple as that. And that frustrates, I gotta say, that frustrates every MBA I work with, because they have spent an entire quarter or semester working on cash flow and internal rate of returns and all these fancy methods. And lo and behold, what really drives the valuation of companies is none of that. What really drives the valuation is the business model of the investor, not the business model of the business. Right? That's a reality of fundraising as well. Okay. And this valuation has not been fixed. Again, the market for early stage companies has changed over the years. So back in the internet bubble, back in 1999, you could probably get away with selling 25% of your company for the same amount of money. So that $1 million, you might be able to have a valuation of $2 or $2.5 million. In 2001, the valuations were really simple. There was none. There were no checks being written by angels and VCs. There was nothing you could do to get any money. There was nothing you could value your company at that would get a reasonable investment. 2004, finally the market cracked, but the norms at that point were 50-50. The VCs were happy to value your company at whatever your need was. You need $1 million, great. We'll value it at $1 million. You need $2 million? I can do that. I've been sitting on my capital for 4 years and I got to put it to work. So we'll value your company at $2 million. And that may sound crazy. That actually happened to me. It went all the way up to $3 million. It didn't matter. Whatever we asked for, they would value it at that same rate. Crazy but true. And these days, it has come back down and it's back to 35 or 40%. So this 0.67 is about right. And if it sounds terrible to you, sounds terrible to a lot of first-time entrepreneurs that you have to give up 40% of your company to get the money, I'll point it back. You got two choices. A, you don't have to take their money. Go back, do a financial plan that needs less, way less, raise money some other way, right? Do a crowdfunding campaign. Or just take the fact that you are trying to create something big, and the only way you can do that is with some capital, and that is the cost of capital. Cost of capital is 10x whatever they give you. All right, and the last And last note on this whole 10x business, just note that's just for seed and startup phase businesses, right? So the earliest stages when you get your first money from any outside investor, their expectation is 10x. Their expectation is 5 to 7 years to see a return on investment. If you get money after that, once you're up and running and you have revenues and you have customers, at that point, the expectations are lower. Once you're past that and you're doing $1 million in trailing revenue, $1 million in the last 12 months, then the expectations are even lower. At that point, you probably can go to banks and just take out a loan. You may have to sign off your house or not, but at some point you can start to take debt and the cost of capital comes way down. And when you get all the way, if you get all the way to one of the few companies that goes public, that cost of capital is way, way, way lower than 10x, right? So I'm just talking about the numbers and the realities of raising money for the very first time or the first true sale of equity in your company.